Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. And on this episode, we're going to discuss Trump versus 529 versus UTMA accounts, as well as we'll look at gifting appreciated stock, also the Strategic Petroleum Reserve, and rising energy risks. And we'll venture on over to the Plan Solutions Incorporated office bulletin board, where we have two fun items pinned up there. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance. Mr. Armour, how are you, good sir?
I'm doing well, although, it's been busy. Usually this time of year, summer, it's kind of quiet. But, I never figure out the ebbs and flows of how things go. But, yeah, been keeping us busy this summer for sure.
Yes, sir. Well, glad to hear it. And hopefully you will still get some of those summer reprieves in there. But let's dive right in. This has been an interesting topic. I'm really glad that this was touched on in the Personal Financial Review. Trump versus 529 versus UTMA accounts. Been a lot of buzz around this, especially the Trump account. We have kind of touched on it before. But let's start there. What really is the short answer, so to speak, or the insight to give around the Trump account so that we can, take a look at these three from the bird's eye view, so to speak?
Yeah, obviously the Trump account is new, right? The new thing always gets a lot of press and a lot of attention, and people really hyping it up as, these benefits and can be used this way. And those things are true, but at the same time, it's just another type of account, right? And it's got its pros and cons, and as often with these things, the devil's in the details. So really, rather than just focusing on one type of account, it's better to take a step back, right, and say, okay, what are the goals, right? What are the goals and objectives here that we're trying to accomplish? And then look at all of the options that are available and say, okay, which of these options fits, this goal or objective, which, may point to, a different account or maybe multiple accounts, right? Because you could have different goals and objectives for different amounts of money.
Yeah, absolutely. Well, let's dive into the objectives, or not so much the objectives, but what the outcome would be by choosing each of these accounts. So Trump account first. Let's start there.
Yeah, so I think whether that's the right choice, right, depends on the family, the children's age, budget, savings goals, priorities, long-term financial goals, as we talked about. Now, the most attractive feature of the Trump account is the free $1,000 government contribution for children born between January 1st, 2025 and December 31st, 2028. Obviously makes sense, right? Take advantage of that if you can get $1,000 for free. Then whether it makes sense for the parent or family members to make contributions is kind of a different story, right? Because will those dollars be better served going elsewhere based on the rules? But one other kind of interesting factor is there's an annual contribution limit of $2,500 for employer contributions. So if an employer has a cafeteria plan, they can make contributions to these accounts, and it's tax-free. So it's not taxed to the employee, and gets deposited into the account. So that's attractive because you don't get that with any of these others. So the $1,000 seed money, if an employer chooses to offer that as a benefit, which I haven't really run into many that are, but again, these plans are very new, so that may change. Those things are great opportunities. But the annual $5,000 contribution limit, that really is take a broader view and look at the other options and see what makes the most sense.
Yeah, and I know we're going to touch in a little bit more on how the account works as we discuss through this, but that's a pretty good amount if you figure, to my understanding, and I don't mean to skip ahead, but I think it's relevant to bring this up now, is that's up until the child is age 18, right? Or the year in which they turn 18.
Right. And then at that point, it becomes the child's money, right? So that's one of the other issues is obviously control over the money. Um, that can be a little worrisome, right? If a child, if a fair amount of money accumulates and then it's turned over to them at age 18, will they make the right decisions with that money? And at that point, it's basically a retirement account, really, is something that I don't think is talked about enough. It works very much like an IRA in that if they take money out, the contributions have already been taxed, but the gain, the growth would be taxed as ordinary income. And there's a penalty if they take the money out before age 59 and a half, unless it's one of the qualifying distributions, right? So things like, paying for education, first time home buyer. I think there's even an exemption for like starting a business or something like that. But if it's used for just normal living expenses or, buy a car or pay for a wedding or, whatever it may be, it might not be the most effective plan, given the taxation and the penalty.
Yeah, but I mean, in to your point, in doing the math in and around it, what we're looking at potentially $92,000, something like that, by the time they turn 18. So if they were to use it as a retirement account, we're talking about something pretty robust at that age. That if you let it, come to the point of maturation, you might have a pretty good. And I'm not counting for any of the gains on this either. You have a pretty solid account potentially.
Right. Yeah. Which could be a big amount of money. Do you want to turn that over to an 18-year-old, right? And make them in charge of it. So that's part of it that's kind of worrisome. And will they get the long-term benefit of the tax deferred growth and avoid the penalties by thinking long-term? Maybe, and that can be a great way to really set them up over the long term. But if there's shorter term goals like education, it might be something like a 529 plan would be a better option because with the 529 plan, you get the tax deferred growth. You get tax-free withdrawals if used for qualified education expenses. As we've also talked about in the past under current law, you can transfer up to 35,000 of unused funds into the beneficiary's Roth IRA, right? As long as the plan's been around for 15 years and they meet the income requirements. So it's probably the better vehicle for education. Still has some benefits in terms of long-term, for retirement. And one of the great things about 529 plans is the owner gets to retain control, right? So even though you have a beneficiary, even though they may be 18 or 21 or reach one of those age milestones, where normally they would get access to the funds, the owner can still control that. So if you don't trust that they're in a position to be able to manage that type of money, you don't have to turn it over to them at that point.
So with the 529, just for the clarity, is the opener of the account has the control about it, how funds are dispersed, and then at some point they make the decision to relinquish the control of that account?
They can. They could actually, continue it through multiple generations. They can transfer money from one 529 plan into another one for a related beneficiary. So let's say if, the kid doesn't go to school, but their sibling does, right? And it's going to be really expensive. You can shift funds that way. So there's a lot of flexibility built into it.
Yeah. Well, all right, let's touch on the UTMA accounts and why they might be an effective wealth building tool and in a different way than these other two.
Yeah, so the UTMA accounts provide more flexibility. So it's basically a way to gift money to a minor child, right? There's a guardian on the account that oversees it. And then with the UTMA account, once they turn age 21, the child assumes control of the account. And the money can be used for anything. There's no penalty like there is with a Trump account or a 529 account if it's not used for qualifying expenses. The downside could be the taxation of a UTMA account. They have very special rules when the child is still a minor. A certain amount of the earnings is not taxed. Then the next certain amount is taxed at 10%. And then anything above that is taxed at the parent's highest tax rate. But usually with good planning, you can minimize that. And a lot of times, if the child takes control of the account and they're still in a low tax bracket, if they're selling assets that have appreciated, it's being taxed at long-term capital gains rates, which are lower than ordinary income rates. The taxation can be a downside, but it can usually be managed and you don't have the penalties. So it offers a lot more flexibility. But unlike the 529 plan, as we just discussed, it doesn't offer the long-term control over the assets. Once the child turns age 21, it doesn't become their money.
Yeah. Let's dive back into the Trump accounts. And, we touched on how they're designed to help families really begin savings for a child's future retirement. It really is the benefit around this. But what do we want to understand around the distributions of it when it comes to that point of, we always talk about that, early withdrawals, the penalties, and so on.
Yeah, I think it's planning ahead for what the money is intended for, right? And determining if that makes the most sense. Really, the Trump accounts, I think, have kind of two very different, very opposite situations where they work well, right? One is obviously the free money, maybe someone who wants to add a little bit to that, right? And with the idea being that the child will learn about investing and learn about the idea of setting money aside and seeing it grow and seeing the benefits, right? Even if it's not a lot of money over a long enough time period, you could see that exponential or geometric growth that can occur. Maybe that, sets the child up for a lifetime of saving and investing and making smart financial decisions. On the flip side, as you mentioned, it can be a great wealth transfer vehicle, right? So if a family is able to do $5,000 a year and continue to invest that and have it compound, it can be a significant amount of money by the time the child turns 18, but you can only imagine what that would grow to by the time they're age 59 and a half and maybe looking at retirement, right? So transferring assets out of the parent's estate into the child's estate in a way that will defer the taxes and get the child off on a really good start for long-term retirement. But you're really counting on that the child will have the knowledge, the education, the understanding to do the right thing and make smart decisions around that.
My last question around the Trump account is, you mentioned that the contribution for any child born in that date range, but let's say you have a 12-year-old. Are you still able to open one of these accounts?
Yes. Yeah. As long as they're under 18, you can still open the account. You just don't get the free money from the government. Although there's a number of other opportunities that are emerging. The Michael and Susan Dell Foundation said they would contribute up to $250 for the children that didn't get the government money, but they have to live in certain low income zip codes. One of the heads of SpaceX donated a bunch of their stock right after the IPO to fund similar things. I saw Mark Andreessen, I think it was the state of Indiana, said he would donate to all like low income kids in the state of Indiana. Let's see, there was another one. I'm trying to remember an employer that said Micron, everywhere that they have offices will contribute. So it may be worth looking into, right? If you live in one of these geographic areas where private donors are contributing and qualify or in a qualifying zip code, you may still be able to get some seed money going into it, which really is kind of interesting. It's created a way for some of these wealthy philanthropists to basically just make direct giving, rather than going through a charity or something like that, where maybe there's administrative costs, maybe the goals of the charity, changes over time, and now you're not real happy with how they're using the funds that you donated. This is a way where you basically donate directly to those individual minor children, to help them get started.
Yeah. Awesome. Well, I know that obviously all three of these accounts, they're focused on helping families build wealth over time, but each serves a different purpose. So it's important that, as always, talk with a financial planner around these and really assess what is best, or maybe it's all three vehicles.
Exactly. It could be. It could be if people have sufficient funds and they're funding multiple goals. Yeah, that could make sense. But it's just really important people understand the pros and cons, right? Not just some of the news stories that are really hyping some of the benefits, but not talking about the drawbacks and not comparing it to other options that might be a better fit.
Yes, sir. All right, let's jump into gifting appreciated stock. Gifting stock and cash may seem alike, but they're taxed very differently. So we're pretty aware. We touched on recently about gift giving, what the cash, what the limits are before any taxes will be accrued of any kind. So let's dive into the stock side of it. People may have a lot of misconceptions about when you gift appreciated stock and transfer shares instead of selling them first.
Yeah, we've talked about in the past how, each individual can give another individual up to $19,000 a year. It's not deductible for the person giving the money. It's not taxable to the person receiving it. You don't even have to fill out a gift tax return because it's considered de minimis, right? So it's pretty simple, but there may be opportunities for more advanced planning. So let's say, an individual has some highly appreciated stock, right? And, they're looking to gift. They could give $19,000 of that appreciated stock. Now, the difference is, there still is no tax deduction for the person giving it. The person receiving it is not taxable on receipt of the gift, but the original owner's cost basis also transfers with the stock. So, let's say you bought shares of NVIDIA for $1,000 and now they're worth $19,000. If you were to gift that to someone else, they would still have that $18,000 unrealized gain, right? If they sold, they would be taxed on that $18,000. But if you're giving it to a child or a grandchild, they could be in a much lower tax bracket. And if you're in a very low tax bracket, long-term capital gains have a 0% tax rate. Or maybe they're, taxed at a, 15% tax rate if they have moderate income, but that's still maybe lower than the, 23.8% that someone with much higher income would pay, right? So there's still some benefits there. It's worth weighing those options and saying, hey, does it make sense to shift this tax burden to somewhere where it'll be much lower, right? Than it would be if you sold the stock and then made the cash gift.
Yeah, let me see if I'm tracking with you here. So maybe it's somebody makes a purchase, as you shared that example, $10,000 in stock, then it's worth 50. They transfer it to someone that is in that zero capital gains tax rate. And then they created a gain essentially of $40,000. Let's say when they go to sell it, and they might be able to transfer then that money to another savings vehicle, investment vehicle. Where my mind is going with.
Yeah, or maybe with the given where their income is at and where they are in the tax brackets, they can't sell all of it in one year and avoid the taxes, but they could sell it over multiple years, right? And keep that gain taxed in a lower tax bracket, which again, with the preferential rates could be as low as zero. So they still have the ability to plan around it. So it's an option worth looking at. Now, the other thing you have to weigh this against is when someone inherits appreciated stock, they get a step up in cost basis. Basically means the gain goes away, right? So in your scenario, if it was purchased for 10,000, it's now worth 50 and you gift it, you're gifting that $40,000 gain along with it. But if the original owner passes away and leaves it to, the beneficiary, then their cost basis would increase to 50,000. If they were to sell it, there would be no tax. So you also want to weigh the pros and cons in terms of, generational planning and the transfer of wealth and what's going to be the most efficient.
Yeah, absolutely. So, as always, important before deciding to gift shares instead of cash, consider all of the tax implications.
Yeah. Yeah. I mean, look at, what's the end goal here, right? And then what's the best route to achieve that goal when taking into account investment risk, tax, implications, estate planning. How that fits into the overall estate plan is important too.
Yeah, well, and as you've said in past podcasts, people sometimes have this negative emotion. Well, I just don't want to pay taxes on it. And that's not always the best strategy. Sometimes the best strategy is that, yes, you are going to pay some taxes.
Yeah, and if maintaining control of how the money may be used, things like that are important, then often there's that trade-off between the tax efficiency and the end goals of what you want that money used for.
Yes, sir. All right. Well, let's jump into the Strategic Petroleum Reserve and rising energy risks. The U.S. Strategic Petroleum Reserve's role is to provide emergency oil during major supply disruptions to help keep fuel prices from rising too quickly. Of course, we've had all the different stuff that's been going on in and around fuel prices. Where is the SPR, Petroleum Reserve, at right now, maybe compared to the past? And what could be an indicator of the state of it right now?
Yeah, so we've kind of hit a perfect storm over the last several years as far as oil reserves go. Currently the Strategic Petroleum Reserve holds about 316 million barrels, but that's down from 638 million barrels in 2021. So we've seen a big drawdown. Of course, part of that was done to try and keep oil prices low during the high inflation years of 2021, 2022. But then when things kind of normalized, it was never built back up, right? As you would normally do when prices fall. And now with, the conflict with Iran and the continual on-off closures of the Strait of Hormuz, obviously that's creating oil supply restrictions. And so, they've been drawing on it there as well. And now, it's getting to the point where it's about half the level that it was before, which is a concern because it's basically creating a situation where there's less flexibility, to be able to draw down on that to keep prices low. Or if there was additional shock, like, hurricane shuts down the Gulf Coast refineries or, some other global tensions that, spills over into other areas that are dependent on for oil supplies. So, yeah, we're kind of slowly seeing the effects of these different things, especially the most recent conflict in Iran and the negative implications that's having. And, how much time are we going to be able to buy and how much flexibility will we have over the longer term?
Yeah. Well, and we've talked about this before, but it's been important to touch on again. Higher energy prices don't just affect us at the pump. It's everything associated with it. Things that are products that are made with petroleum, transportation, shipping, heating. It all pushes the cost up higher. So it presents a big, well, my words, big factor. Please correct me in potential inflation.
Yeah, higher oil prices does have a big ripple effect because, first, obviously, you just have the higher cost at the pump, the higher cost of energy. Then you see that spill over into transportation, shipping, heating, right? All of those things. So you'll see the whole goods sector, things that, physical things that need to be transported, that will start to show through in the final prices on those items. And then usually with a lag, you'll start to see services prices go up because, the biggest expense in services is wages, salaries, right? And, people will start to demand higher pay increases just to keep up with inflation, right? Just that normal cost of living. So yeah, it'll typically have a ripple effect all the way through, the inflation numbers. And, then higher inflation leads to higher interest rates, which leads to slower economic growth, right? I mean, it has this this whole downstream effect that goes through the entire economy.
Yeah. Well, and I know that it's included in here, and I had seen it in one of the headlines that, some are arguing that the risk is smaller today because the U.S. produces much more oil on its own than back in the 1970s when there was like that fuel crisis. But that doesn't really mitigate all the risk. There is still so many factors that go into this.
Yeah, there's a lot more flexibility in the energy markets, and a lot of that does come from the U.S. and fracking technology and the ability to get access to these smaller reserves of oil that we didn't have in the past. But that also typically comes at a higher cost because fracking is just more labor intensive. Again, they're not drilling and pumping, right? They're constantly drilling to break up these shale formations to get to these smaller pockets of oil. So if we become more dependent on that source, we're likely going to see permanently higher costs than we would have otherwise. And if that's the case, that's going to make it a lot more difficult and costly to refill the strategic petroleum reserve over time.
Yes, sir. All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. We've got 2 items pinned up there this week. What are they?
Oh yeah, just kind of having some fun with it. I mean, we had Katie Dunham's birthday was this Friday, so that was nice. We ordered sandwiches during one of our meetings and celebrated that way. And then of course the thing that you and I were talking about before we started recording here, which was with the World Cup, right? I mean, that was huge. The amount of viewership, they broke records in the U.S., they broke records worldwide. Spain beat Argentina 1-0, which, as you know, I was very happy about. Other than the U.S., the country that I spent the most time in is Spain. I have a good friend, my old college roommate is from Spain, so I spent a lot of time in Barcelona. Love the country, love the culture, and from having spent time there, I know how much that means to them to win the World Cup because it's definitely the premier sport there and a big source of national pride. So congratulations to Spain.
Yes, sir. It was a lot of fun to follow along. And of course, I was in New York during a lot of the time of a lot of the games early on and was able to, in our hotel, literally meet people from all over the world. So it was cool too. We didn't attend a game, my son and I, but we had a great time with that and really seeing how alive the city of New York City was during that time. And my son let me know he had filled out a bracket. He didn't tell me this ahead of time. He had actually picked 3 of the final 4 teams and the winner. And I said, son, we could have parlayed this into something. You had a pretty like 75% bracket from once the elimination rounds were done here. But literally picked the winner. And so he had a great time with it. So it was cool to see him get into, he's so fascinated with world cultures. And I think he is now a soccer aficionado. So it was a fun time for the whole family.
Yeah, it's great to see these events, like the Olympics, the World Cup, that aren't necessarily annual things. So it's more exciting because they're every 4 years and just to see how it just brings the whole world together.
Yes, sir. Anything else you want to add, Chase, before we wrap up this edition of the Plan Solutions Incorporated podcast?
No, I think we covered it, but I'll loop back to the Trump account question because again we've been getting a lot of questions and things from clients, and I just encourage them, by all means reach out and let's talk it through to see if it's the best vehicle.
Yes, sir, absolutely. Well, we thank you all for listening to the Plan Solutions Incorporated podcast. Please hit that subscribe button if it's your first time. Maybe you're listening on Apple Podcasts, Spotify, whatever platform. Hit that subscribe button. And if you prefer a visual form of how you take in your podcast content, we do have a YouTube channel, youtube.com/@plansolutions. And you can subscribe there, leave comments in the comments section if you have any questions or maybe a topic you'd like discussed. And, we can pass that along when the personal financial review is being put together. So please go there and subscribe and get subscribed to the personal financial review as well if you have not yet. It's simple to do so. Send Katie an email, the wonderful lady that we recently celebrated her birthday, KATI@plansolutions.com. If you email her, just title it Personal Financial Review. She'll get you subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.